Every day it gets worse. Each moment weakness falls over the markets, taking it down further and further. But what happened to the fundamentals? They told us everything was so fantastic. That doesn't seem to matter right now. Or do fundamentals actually matter and they're not looking good and this event is simply a reason to take profits? That could mean the difference between a correction and a bear market. Many have wondered how quickly things can turn around. Is now the time to buy the dip or am I about to lose my shirt? You came here for the truth, so let me unveil that for you. Today I have a massive video for you. I think I have something like 28 tabs open. It's gonna be huge. You have to watch what we're doing on a day-to-day basis. That's what's different about this channel, is that we are documenting every single thing. We're gonna go back to this 5 years, 10 years, 20 years down the road and see it all as it happened. This has never been done in history before, but today was another historic day. We're looking at the biggest point drop in history. So we need to get into all the details here. Let's begin. You're looking at the markets and you could see another day red across the board. 1190 down on the Dow Jones, the S&P, the Nasdaq, of course. Looking at the markets all around the world, in Asia and Europe, everywhere is a sea of red. The VIX, of course, had moved up, now at 39. I do believe this is significant because there have only been a handful of times where the VIX has gone above 40, and this would be very serious if it gets there, which it looks like it will in the next trading session. Of course, we never know, but that just shows you what has happened in these few days. Dow plunges 1,100 points, bringing its decline from a record high to more than 10%. Actually, it's not 1,100, it's actually 1,190, and it's not 10%. I believe I calculated it more like 13%, but regardless, this is what CNBC and all of these other mainstream channels do. I have to get this off my chest. I posted it on my community or blog section of my channel, and I specifically mentioned what's going on. I found this to be a pattern over and over and over and over again, so I had to make a post about it. That's what I do, I document. What I find is that when the stocks are moving down, the articles that they do, which are constantly being updated throughout the day, they don't get updated as frequently if the stocks are moving up. So if we have a down day, it's going down, it's 400 points down, and then suddenly it's 500 points down, and then 600 points down, the article will stay with 400 points down for 20 minutes, for 30 minutes, and it just goes on. But if the stocks go up in the other direction, they're up 400 points and they're up 500 points, every interval they're updating that article, and I do believe that's on purpose. I just think that's the way it is because they have a reason to make sure everybody buys. You've heard the old saying, it's a bull market somewhere. I wonder who said that. Let's go on to the next one. It took stocks only 6 days to fall into correction. That's the fastest drop in history. This is what people don't understand. What we are experiencing right now in real time is very significant. We have this external event that took place. It didn't happen because of the fundamentals of these companies. It didn't happen because of earnings. It isn't happening because of what we're seeing with the jobs reports. This is something that they can't control, and that's why they're freaking out. We were watching the markets going up parabolically. We saw it rising like crazy. The example, of course, being Tesla. It's going to be $7,000 a share. No. It's going to be $15,000 a share. And you know what? There might be a day when that is true. But to put yourself out there and suggest these numbers, as far as I'm concerned, to look at it where we are today and project these numbers is just to get attention. That's a whole different story. The point I'm trying to make is that we have this euphoria that's going on. Just keep raising the bar, raise the bar, raise the bar, get that attention, get the money flowing in, and then when you have something that happens, a crisis of any kind, we flip on a dime. The market is going down so significantly because it came up so high. A lot of people are taking their profits. Look at what all of these insiders have done. This is the most selling insiders have done ever. This is something that I've been showing you. And of course, you need to keep up to date on what the insiders are doing because they know what's going on before you and I do. 6 days, fastest correction in the S&P 500 on record. Look at this, Feb 20, right on the right-hand side, Feb 18, and we saw what was going on in the early 2018 where the markets fell because of the VIX index, if you can believe it. Something that really shouldn't be that significant, but people were piling into shorting the VIX, shorting the VIX, shorting the VIX. By the way, just prior to all of this that we're seeing right now, we had exceeded the amount that was shorting the VIX. I want to know how many people lost their shirt by going in and making the same mistake again. You can look at the other examples, of course, through this chart here. I just wanted to bring it up to you just to give you some context. Market corrections since the 1940s. The 26 corrections have averaged a decline of 13.7% over 4 months and have taken 4 months to recover. What we tend to find is that the markets go up and they start slowly, and then the further along in the cycle, they get more and more exaggerated. And this is when the retail investors start to pile in as much as they possibly can. The insiders start selling off along the way, but nobody really notices that. It's all kind of quiet, but the retail investors pile in. That's where you can see if you look at Robinhood. I've shown you the websites that track all that. There's some really good stats out there today that we can monitor all of this that we didn't have in previous cycles. Regardless, then we saw that turn around and it happened so rapidly. Nobody's prepared for it. And I'm going to show you in further into this video why people who think they're prepared, who think they're ready, might encounter some problems. Take a look at the MSCI World Index versus the 200-day moving average. We can see it as it comes through in 2018, how it finds support. It's bouncing along there, but it falls through. And of course, this was the fourth quarter of 2018. Not looking so good. Once it made it past the 200-day moving average again, it finds support along that line. Here we are at a very pivotal moment. But this happens to be the MSCI World Index, but look at it across any different stock market. Once it falls below this support line and remains there for a short period, it is very worrisome as long as the technical analysis still plays into it. SNP Performance year to date. Take a look at this. You can compare this to all the different years in this particular cycle, going back to 2008. It's worse than 2008, if you can believe it or not. This is what we have to deal with today, if you can believe it. We're talking about how fundamentally everything's so beautiful, everything is fantastic, and then one event wipes out all the gains from 2020, wipes out all that euphoria. The market is down into correction. Well, our friends at the Federal Reserve are always there to cheer us up. And in this case, the former chair, Janet Yellen, said that depending on how widely of a problem this becomes, the economic impact could have a significant impact on Europe and veer the US towards recession. We could see a significant impact on Europe, which has been weak to start with, and it's just conceivable that it could throw the US into a recession. Thanks, Janet Yellen. You make me feel so warm and fuzzy. Market participants will look to the Fed to provide some support. In most developed countries, interest rates are really low, and they are very low in the United States, but higher than they are in most other developed economies, and the Fed does have some scope. It will provide a little bit of support to consumer spending and to the US economy and for financial markets. And then she basically says the government has to do their part with fiscal spending. So let's be very clear what she's talking about. This is a rate cut. She wants the Federal Reserve to cut rates. And I don't think anybody's denying that right now. I'm going to show you what the market believes is going to happen. This is unbelievable. As soon as the markets fall by any percentage, when the markets were down 5%, we were seeing people yelling and screaming, you got to cut interest rates, you got to cut interest rates. Market falls by 10%, we have more and more of those people. Cut interest rates, 50 basis points. I don't care. You have to do it. What will you do when rates hit zero? I got an idea. You're going to be calling for those negative rates. You're going to be calling for that. So many people will, and they don't understand it, but they'll do it anyway. The former Dallas Federal Reserve president had some really good things to say in this interview, and if you got a few minutes, definitely watch it. I think the market is getting ahead of itself because the market is dependent on the Fed. Have you heard something like this before? Well, surely you've heard it here at the Money GPS, but do you hear an actual Fed president saying that? Well, definitely not when they're at the helm, but certainly when they leave, some of them have some interesting things to say. The Fed has created this dependency among a generation of money managers who were not working in the field during the previous moments of economic challenges. They weren't there in 74, 87, in the late 90s, and even in 2007, 2008, and 2009. They have only seen a one-way street. Of course, they're nervous. The question is, do you want to feed that hunger? Keep applying the opioid of cheap and abundant money? Money is already cheap and abundant. I completely agree with the former Fed president. It doesn't happen too often, but this is so accurate. We're looking at interest rates around the world so low right now. So many countries have negative interest rates or they're at 0%. How much lower can you get? You don't understand what you're doing to the financial markets. You're breaking them and you're going to create an even bigger crisis later on. You cannot fix what's happening coming in externally. You can't cut rates and assume that that's going to make everything okay. What are you going to do? You're going to take them down to 1%? All right, that's just fine. And then 6 months later, we're dealing with another problem. Let's say right here, right now, they cut interest rates down to 1%. And we see after the market had done a serious correction, let's say it's down 15%, then it comes back up and we gain all of that back. All right, looking at the Dow Jones, it's back up to that 30,000 mark that they've been hoping and praying for. And then we have another external event and it comes down yet again. And then what are you going to do? You're going to cut rates to 0.5%? You're going to cut rates to 0%? Are you going to go into the negative? What exactly are you going to do to fix the problem? You can't keep this up. It doesn't work like that. The money is already cheap. There's so much of abundance of cash right now. The only thing that's expensive is if you're borrowing on your credit card. That's it. That's it. Look around the world and see how crazy things have become. Goldman sees zero earnings growth for US companies this year, and you know exactly why. Imagine that, 0% growth in 2020, a year when they told us things were going to be very good, things were going to be fantastic, and yet that isn't the case. Could have been this situation, it could have been another situation, but why aren't they willing to admit what was going on before that, what was leading into 2020? We're talking about issues that are fundamental here, and we are always looking at what's relevant today. Truly unfortunate. And then we have Jimbo Cramer. Take a look at some of his tweets. If you came in with lots of cash today, I think it was right to start buying. Tomorrow could be ugly and Monday too. So pick. Panic is not a strategy. We have the most cash this week we have ever had and we must put it to work now. Slowly but surely. I like to buy hysteria, not sell it. We put some money to work at the bell. Still less money in than out this week, but that will change tomorrow. We will be making more buys. This individual here for 2 days was telling people, don't get in yet. We gotta wait this out a little bit. There's so much uncertainty out there. Then he flips 180 degrees and saying, buy, 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 buy. Why in the world would somebody like this flip 180 when nothing fundamentally has changed? In fact, things have been getting worse. I don't know if there's some inside scoop that he's aware of that nobody else is, or is the fact that everything that this individual is about relies on the stock market to always go up. There's a bull market somewhere. That's right. Well, you know what? Jim Cramer is just an individual. Nothing against the guy personally. When you look at it, it's really just the mentality of the average investor. This is the way that they see it. They are ignoring reality, and that is extremely dangerous. And now a little bit of humor here, because a few days ago, it seems anyway, this individual, Wharton's Jeremy Siegel, was talking about how the market's going to go up forever and ever. And now he says the Fed needs to cut rates. This can just snowball. Oh yes, the panic has set in. When you look at it, as soon as the market comes down just a little bit, they're calling to help me out, help. My entire business, my career, everything I got riding on this right now, leveraged to the absolute maximum. You can't let it go down at all. You can't let this fall. You need to cut rates. You need to cut rates right now and save me. That's embarrassing. Right here, they should be proactive in this situation. Well, what exactly are you talking about? They already cut rates 3 times in 2019 to be proactive. What exactly are we being proactive about? There's always going to be something. If it's not this issue we're dealing with right now, 3 months from now is going to be something else. Are you just going to keep cutting rates? There's going to be rates at minus 50%. Is that what you want to do? Just keep cutting and cutting and cutting and cutting. No, it doesn't work like that. There's a reason why interest rates are put at where they are at. You have to print money to get them there. You got to print money, and they can't continuously do that without consequences. Look how messed up things are today because of the activities of the central bank. And this is really good. JP Morgan says, buy the dip, bank on Fed insurance cuts. That's right, JP Morgan is sticking with this bullish market forecast, betting on potential Fed insurance cuts to lift stocks. Now, that's not my wording. That's literally coming from JP Morgan, that they are going to cut interest rates and lift stocks. Well, whatever you want, it's fine with me, but this is just unbelievable how they project this information on people. Bank of America cuts global growth forecast to the lowest since the financial crisis. Yet another bank doing this. We're seeing this now consistently. And why? We know what's going on. We know how much of an impact this is having on a global level. You can't stop this by cutting rates. That's what they're worried about. Market pressure heats up on the Fed with at least 3 cuts now priced in for 2020. Unbelievable. 3 cuts. They're going to go to 0.75% down. We're looking at it under 1%. Is that what they're calling for? Can you believe it? Cutting the current rate in half, basically. This would be amazing to see. Of course, maybe we would watch the stocks rise as a result. Maybe, just maybe. They cut interest rates a few times or the next few meetings. They get the market to boost back up. Everything is so fantastic. But you're not left with anything. Anything. Right now, you could argue, well, you look around the world and interest rates are very low. Look at what the ECB has done and others in Europe, in Japan, and so on. But 1.5% is still very low. You can't argue that. If we make it down under 1%, you're basically at the bottom. Toronto Stock Exchange halts trading for technical issue amid heavy volume. Wait a second. How is that possible? I can't get in to trade. I can't sell. I can't buy. This is what happens on a fairly regular basis when you have an issue like you're experiencing where so many people are trying to rush in or out. You have complications. This is what can occur to you, and it's going to happen on the worst possible time. Just like I used the analogy a few days ago, you see with your air conditioner, when does it break down? In the middle of winter? No, it breaks down on the hottest day of the year. What about your heater? Does that break down in September? No, it breaks down on the coldest day of the year. This happens to be the Toronto Stock Exchange. It can happen anywhere. I'll show you some others in just a second. This happens to be the Toronto Stock Exchange, but I've noted previously, and I'm sure you've seen it before, where people have been unable to access their brokerage accounts. It's not one market. We're seeing this everywhere. Yes, they can get back in. Maybe it's an hour, maybe it's a few hours, maybe it's a day, whatever. But the point is that you call it a liquid investment. You say that you can get in and get out in a minute. But what happens when there's a problem? Just like a bank holiday, just like so many other events that have happened, it isn't so one-sided. Take a look at the comparison here between gold and the Dow Jones, gold being, of course, the gold color, and the Dow Jones is the green. Gold, while it's off from its high, it's still up significantly. By the way, this is normalized as of the beginning of the year. It's up 8%, whereas the Dow Jones is down. On this chart, it's definitely outdated, 8.5%. This is down into correction territory. But if you see it on the chart, it's happened in such a short period of time. I mean, mid-February, we saw a mass divergence in between the two. Gold started to climb really before the Dow started to fall significantly, and it's just been a matter of a few days where it has fallen off a cliff. Odds of a 25 basis point rate cut in March 2020. This has risen dramatically over these past few days. I think it's pretty much a done deal at this point. We'll see what happens. S&P 500 versus the Fed balance sheet, you could see that these have diverged big time with the S&P falling so heavily. I think actually at this point it's a bit oversold when you look at it on a technical basis, but that doesn't mean it's going to stop anytime soon. And this just shows you the S&P versus the Global Liquidity proxy. Going back into 2018, we saw a similar pattern. That's all I'm trying to show here. And take a look at the bank stocks that have been battered. JP Morgan down 10%. Just to give you an example, it has fallen day after day after day. And we're talking about companies that are global, systemically important banks. If they fall, we're in big trouble because they've interconnected everything that we do to their derivatives, to their schemes, to their gambling, and they bailed them out. And who got in trouble for what happened in 2008? Absolutely nobody. What about everything throughout the 90s and the 80s and the derivatives that Frank Partnoy started talking about, and nobody even knows who Frank Partnoy is? Who dealt with all those issues? Well, of course, nobody. Nobody ever gets in trouble. It's just the way it works. Oil has fallen dramatically. We're looking at it now down to $46 a barrel for the WTI, and the Brent is approaching that 50 mark. We'll see what happens with that. Certainly has changed in just a few days. That's all for this video. If you found it informative, hit that thumbs up button. By clicking one button, you support this channel. Thank you very much. If you want to learn about e-commerce, then check out my free e-course, theamazongps.com. If you want to learn about the financial history that was robbed from you from the school system, check out these two books, link in description. If you want the audiobook, themoneygps.com. Do you want to know what's really going on? Well, then you gotta watch this video. Check it out, click on it, and I'll see you there.